Today I want to talk about, are we in a buyer's or a seller's market? The reason why I wanted Charlie on this one is because, you started with this company, you had 18,000 units and you had over 50,000 when you finished. And, and so you had an opportunity to look at, buy, due diligence, a source, meet with brokers, multiple markets, a tremendous amount of experience over the last 5 or 6 years. And so you're going to have some pretty good optics on, trends, right? You saw the trends go up. You've seen trends go down. You've even seen markets go up and down. Now we've seen these interest rate increases. So where are we today, and where do you think we're headed?
We're actually starting into the beginning phases of I would consider a buyer's market. At this point, if you, as a seller for me, if you don't know where your legs are yet, and the people that are going to be selling are going to be long-term owners that have a really low basis and they're nervous about the future, and so they just want to take some chips off the table. So as long as you're buying you're hitting your metrics and you have a long-term approach, I don't think you're not in the burn and turn phase of the market. You're in the I have an opportunity to go up against a lot less people. Institutionals are out of the picture right now until they clear their sheets. And so you have an opportunity to go in and conservatively buy something long-term. I think it's a good place to be. I think the real big kicker IRRs, the short-term stuff is going to come once you start getting the sellers that are selling because they have to sell. And they are way up. They're way out over their skis and they can't afford it. It's about to go back to the bank. They're trying to just salvage their investors' money and not default on a loan. That's where you're going to get your big, hey, I could buy this, turn this around and get rid of it. But I think it's a great opportunity to buy the next 6 to 12 months if you're a long-term owner. Yeah.
I would say that most sellers have to sell, or like you said, they have a lot of equity, right? But if you don't have to, for any reason, you don't have any pressure from your dad or your equity, there would be no reason to list your property.
None.
Right now?
No.
Isn't that right?
I agree. There's no reason to be listed unless one of those two options.
Because the long-term prognosis based on the way the economy's been run by multiple administrations, let's not just pick on the current one.
Yeah.
It looks good. We're undersupplied for housing. It's been corrected because of the interest rates. We have high inflation, and we don't need to go down that road. But the point is it looks to be like interest rates are going to continue to tick up for a little while. And as long as they do, it's just going to let more air out of the asset bubble, right? Mm-hmm. Is that what you think?
I agree. Yeah. But I think the brunt of it has happened in terms of the asset bubble. I don't think we're going to see, we're down 25, some markets 30, 35%. I don't think there's another one of those coming. So I think, again, if you're trying to time the market, you're always going to be in trouble, right?
And we're talking about multifamilies.
Yeah, that's right. Yeah,
which is cool. Yeah. If we're in a 9-inning game, it feels to me like we're somewhere in between the second and the third inning.
Yeah.
Okay. Do you think that?
Yeah, I think it was a rough first and second inning. But I don't think, if we're talking about end of the game is when we start appreciating, I think third, fourth inning.
Yeah, okay, good.
But a really rough, you got shelled.
Pitcher got shelled. Our button at it. We were up. Obviously, we're way behind right now.
Yeah.
If you're a seller, you're down 15-1.
Yeah.
Or you know what I mean?
Yeah.
And then you're coming out and you're trying to figure out what to do. But I agree. Cap rates are up almost a point, which means that values are down, 20%, I guess, at least on multifamily. And then we're also starting to see residential go down all over the place, right? So we're not far off. And we're in the third inning. You say 3-4, I say 2-3. So let's just settle in on 3. What do you think is going to happen in, say, innings 4, 5, 6?
You're going to have I think it's going to be two things are going to be happening. One, I think you're going to see a lot of distressed product come out. A lot of guys who bought in rougher parts of town, rougher deals, highly leveraged.
Seasonal.
And this is, again, just multifamily.
Yeah.
And they are going to be in a position in which when their debt comes to maturity, they're in no way, shape, or form going to even be able to get out of that. So I think you're going to get that, but I don't know if there's how much of a market there's going to be for that, which is also a really interesting. I don't know how many buyers you're going to have that are really excited to jump back into 1970s chiller deals after what we just went through. And I think the second thing is going to be the flight to where I think you want to be in a buyer's, why I kind of feel like this is a good buyer's market if you're going to go to the flight to quality, is there's no institutional in the game right now. They have to write off all their losses, right? So they're all trying to figure out what they're going to write it off to. And once they clean their books up, I just feel like we have so much capital to still deploy and move. I think once they can kind of write off their losses, they're going to be back to having an appetite again, and they're going to have an appetite for quality. And so I think if you can go in and get into some really good stuff right now, I think that market is by 5th, 6th, 7th inning is going to be the stuff that starts to turn and start looking like it's going to get to the end of the game for them sooner than the tougher located, tougher products. I think they might be in for a much longer game.
I completely agree with you. I think one of the very interesting thing is that you skipped over, well, you didn't skip over, you said it. And what I guess I want to bring some attention to is when Charlie says that institutions are out of the market, what that means is that big Wall Street, big money is out, right? That's significant.
Yeah.
If you just think of that, like, why would that be? Why would Wall Street be out of the multifamily market right now, right? Like, what would you say?
Well, I have a really simplistic answer to it.
Good.
I think it is they're all in a big corporation in which everyone has a job and then somebody has a boss and they have someone to answer to. And in uncertainty, nobody wants to be the guy who jumped off the diving board first, who then has to explain to the 5 people that oversee them or the 55 people that oversee them. The big corporations, those phone calls are always great. There's always 40 people on a phone call.
Yeah.
For a job that should probably take 2. So everybody is just afraid to be that guy inside the corporate that calls it first. There's a ton of groupthink that goes into that. And so I think that's why they're out. There's just so much uncertainty. I don't want to be the company that called it that we're actually in the 8th inning when we weren't.
Correct. Yeah, I agree. And not to mention the fact that it's also short-term money.
Mm-hmm.
So, what that means is if Charlie's, let's say, Goldman, and I get money from Goldman and I buy something, they want it back in 3-4 years?
Yeah.
Right? Okay. So what's just happened? Values have gone down. When they were in the game 1 year ago, their values are down 20%.
Correct.
Right? So they're looking at that.
Right.
They're looking at, if I bought something about $100 million, it's now worth 80.
Yeah.
Right? That's today's value. So they've lost $20 million in value. What the GP may not know is really that's all them.
Yeah.
Right? Exactly. It's the GP is the one who doesn't get the money. The debt and the equity are still probably in the money.
Close, yeah.
Right? Yeah, they might be a little skinny. So they've just had this cap rate increase. Interest rates have increased, even though their cost of money is a lot less than ours. But they're stepping back and saying, we're going to see how far this knife falls, right?
Yeah.
Wouldn't you agree with that?
Agree.